got some spare cash every month, got my home loan under control, and the question is, do I invest, do I pay off my home loan, or do I put it in super? Large cap Australian shares, Vanguard Australian share funds, ASX 300, indexed, low cost. Then we allocate some of our Australian allocation to small companies. So these are companies that are generally outside the ASX 300. You're probably up at that peak where you know what you don't know.
Well, I've gone back down and back up. And with my investment, like if this is knowledge and time, I'm like at the end. And you find a lot of people who might just start investing and buy all my books and your books and really turn this up to 11. They're in the Facebook groups, they're on Reddit. Those people who are at this peak here might be like, well, if you've listened to my stuff for a while, if you've consumed our YouTubes and our podcasts and all that stuff, you would have heard the words Life Sherpa. I'm with regular pest of the show, Vince Scully. Serial pest of the show, Vince Scully from Life Sherpa. Welcome, Vince.
G'day, Glen.
Now, Life Sherpa is your traditional online financial advice business, and you recently, in the last year or so, have allowed direct investors to invest in your portfolios.
Yep.
Through LifeSherpa Invest.
Correct.
And these are the portfolios that you have been recommending for your clients for well over 10 years.
Yeah, it's a subset of them. So there's 4, and they're broadly the way we've been investing for more than a decade.
Yeah. So now you have turned that up a notch and effectively made a Robo-Advice tool on the website.
Yep, which helps you choose which one of the 4 meets your needs.
Right. So just on that, so Robo-Advice, I guess for what we know in Australia, it's scaled financial advice just for an investment recommendation.
I mean, the easiest way to think about what Robo-Advice has become to mean is automated portfolio selection and management. And it has been around for more than a decade. The initial promise was that it would replace human financial advisors, but clearly that's not happened. But what it has done a really good job of is helping people at low cost get access to professionally managed evidence-based portfolios with a low buy-in price.
But Robo-Advice won't tell you if it's a good thing to invest your $20,000.
No, but it'll tell you if you want to invest $20,000,
here's a portfolio.
Here's which one of these 4 portfolios you should buy.
It also won't tell, and correct me if I'm wrong, it won't tell you what entities to invest in.
Correct.
So it will be in the main ordinary money.
Yeah, so you can invest in self-managed super fund, family trust, individuals, children. But you're right, it's not helping you select which entity. That's a much more intensive human activity. This is really saying, I have X dollars to invest. Here's my risk profile and my goals and objectives. Which of these 4 portfolios should I pick?
So what we're going to do is I'm going to share the screen and show everyone live me going through the Robo-Advice on your website.
Excellent.
So a couple of things. With this clip, this YouTube video, I don't know if we're getting into the weeds about the portfolio construction. We can answer all those questions another time. It's not a judgment of the costs of the portfolios and all that. We can talk about it. This is literally just showing people what to expect if they wanted to use your Robo-Advice tool. Okay. A couple of disclaimers. I personally am a LifeSherpa Invest customer in my self-managed super fund.
As am I.
Yeah.
I invest the way we invest.
Yeah. And you have not paid to come on here. Correct. For the skeptics out there, we've known each other for a million years, and I'm just doing this. You don't have to use this. Knock yourself out. Like, we're just doing a bit of a live...
Hashtag not an ad.
Not an ad, but, I mean, everything can be influenced.
And I am responsible for your advice.
And Vince does license our podcast. So let's now share the screen. Okay, so we're on the main page here. Life Sherpa, we're going to click Let's Get It Done. Smart investing made simple. So basically, ordinarily, I can open my account, choose my portfolio, and then get on with my life. And you've got 4 portfolios to choose from.
Yep.
But the Robo section, you can answer questions, and you will
get a recommendation.
So is it a formal recommendation?
It's a full statement of advice in relation to this specific topic. Is I've got X dollars in cash. What should I invest in?
Right. Okay, cool. Okay, why are you investing? I want to build wealth generally for longer term goals. Are you paying off any high interest personal loans or outstanding credit card debt? So why do you ask this? Because why do you care?
I care because I'm about to a recommendation that says you should invest in a portfolio that looks like this. If you're paying 21% on your credit card, I shouldn't be recommending that you invest at 7 or 8% or 9%.
Or at this time.
Or at this time, yeah.
So basically,
if you click yes, it will tell you that.
Right. Maybe now isn't the right time. Paying off your maybe now isn't the right time for you to invest. Paying off high interest debt is likely to. So that's kind of good that from someone who's selling an investment product, ordinarily you wouldn't care what someone's financial position is. You just want to take their money and invest it because you'll earn money off their investments, right?
But by making a recommendation, I now have to act in your best interest.
Right. So
that's the legal, it's both the way we work and a legal requirement.
Yeah. And the right thing objectively, if you have debt, you should be paying off that first.
Other than your home loan, car loan, or X.
Yes. Okay, so we'll go back. So I'll just put no.
Mm-hmm.
Will you need to withdraw money regularly? No, I won't. Life stage. I'm young, I'm single, I'm ready to grow my wealth, but I don't have a specific plan to spend it. I've been working for a while and I'm planning to buy a home or start a family soon. I'm doing well, but have a family and mortgage commitments. I'm planning a comfortable retirement. I'm retired and rely on my investments to maintain my lifestyle.
So all of these questions are going to how long you're going to be investing for.
Yep. I'm going to say I've been, I'm doing well.
You're doing well.
I'm doing well and I've got a family and some mortgage commitments. How long are you looking to invest for? I would say 3 to 7 years, I think, because I want to have a bit of an investment account to fund my Kentucky tour across Europe.
Do they still have Kentucky tours?
I think they do, yeah. Do you have any experience investing in shares?
So now we're moving on to your experience of investing, which goes to your ability to tolerate risk.
Right. So I'm going to I'll just put I've got 5 to 10 years.
Well, you've been in a podcast for 8 years. It must be 10.
No. I'll put 10. In general, how would your best friend describe you as a risk taker? A real gambler, willing to take risks after completing adequate research, cautious, a real risk avoider.
I reckon you're a bit of a punter, Glen.
Vince, what I do with my recreational money. You're on a game show and you must choose one of the following. Which would you choose? So $1,000 in cash. So take it now and get out of there. Flip a coin and you'll win $5,000.
Or nothing, as the case may be.
Or nothing. 25% chance of winning $10,000 or 5% chance at winning $100,000.
So this is going again to your personal psychological leaning towards risk.
I'm probably doing B.
Mm-hmm.
You've just finished saving for a once-in-a-lifetime trip. No, that's what I'm saving for. 3 weeks before you plan to head off, you lose your job. How would you react? Cancel the trip, take a much more modest trip, go as scheduled, reasoning that you need the time to prepare for a job search, or extend your trip because it might be your last chance to go first class. I'm probably cancelling the trip.
Mhm.
If you unexpectedly receive $20,000 to invest, what would you do? I'd probably do that.
Which is what you're about to do.
Yeah, which is what I'm doing.
Mhm.
How comfortable are you investing in shares or a share of ETFs or share ETFs? I'm very comfortable, Vince. When you think of the word risk, which words come to mind first? I'm going to do thrill.
Told you were a mad punter.
Some experts quoted in the media,
Not on this podcast.
not on this podcast, are predicting that the price of hard assets such as gold, jewelry, jewels, collectibles, and real estate will increase and that bond prices may fall. However, experts tend to agree that government bonds are relatively safe. Most of your investment assets are now in government bonds. What would you do? I don't know. Doesn't your portfolio do this decision-making for me?
Well, this is about your gut instinct, so don't overthink it too much.
There's a lot of words there, and because
There is.
I'm not good at reading and comprehension.
In other words, do
Okay.
you go with the experts or the media? Is the broad thrust,
I would
or have a bet each way?
sell the bonds. I was going to do that one.
Yep.
You must choose one of the following investments. Which would you prefer? $200 gain, best case. Zero gain, loss, worst case. $2,600 gain, best case. I'm probably doing that one. Because that's, $1,000 you get to a psychological threshold. That's a lot of money. In addition to what you own, you have been given $1,000. You must choose between a gain of $500 or a 50% chance to gain $1,000. Am I back on a game show here?
You are.
Is this game show called Punked? Yeah, I'll take the risk.
Squid Games.
I'll take the risk. In addition to whatever you own, you have been given $2,000. You're now asked to choose between...
So one's looking at gains and this is looking at losses.
Right.
It's just trying to assess your...
a 50% loss, chance to lose. Okay, so I lose half of it. And then, probably the same. A relative left you an inheritance of $100,000, stipulating that you must invest all the money in one of the following choices. Which one would you choose? A bank account or offset account, an ETF that owns shares and bonds, a portfolio of 15 different shares, commodities like gold, silver. I'm going to go the ETF, I guess.
You're a kind of ETF kind of guy.
You got to do it. If you had to invest $20,000, which of the following investment choices would you find most appealing? Medium, 10% high, low. I'm probably just going to do that middle one, 30% low.
Yep.
A trusted friend or neighbour, we're in Australia, bro, not OUR. Might want to fix that. An experienced geologist is putting together a group of investors to fund an exploratory gold mining venture. The venture could pay back 50 to 100 times the investment if successful. If the mine is a bust, the entire investment is worthless. Your friend estimates that the chance of success is only 20%. If you had the money, how much will you put in? I'm an ethical investor, Vince.
You don't do gold mining.
I don't do gold mining. I do gold digging. Nothing, 1 month's salary, 3 months' salary, 6 months' salary. Look, I'm probably not even bothering.
Yep. I think that'd be me too.
All right. So my investment amount is $20,000. Is there a minimum?
5,000.
First name, Glen, James, age range, 36, postcode, Newcastle. I'm just going to turn this off while I put my email address in so no one sees my email address.
Spam at moneypodcast.com.
Submit. Okay.
So here's your recommendation.
So here is my statement of advice on the 4th of July. Oh, what if someone puts a dodgy email in?
Well, if you click on the
Get started or
the download at the top, you can download your statement of advice.
Yeah, but people could just do this and put a fake email in.
Yep.
Description. So you've recommended the Everest 90 portfolio.
90 means it's 90% growth.
Yep.
So growth being shares, infrastructure, and real estate. And it's split in those proportions.
So 39% Australian shares. What if you're colorblind? Tough luck. Global shares, 29%. There's your download. There's the download. Okay, it must have been a computer issue or something. Oh, we'll read the actual statement of advice. Everest 90, the goal matches your asset. I'm just having a look here. Okay, so this is just all generic stuff. Nice AI chick.
So this is actually explaining what the quiz was
right.
getting to and why those questions
how much risk you can afford to take, how much risk you feel comfortable taking, how much risk you need to take. Okay, cool. So this here
is comparing the 4 portfolios.
So these are your 4 portfolios. Yep. And now you recommend the Everest 90.
Mm-hmm. Because it's aligned to your risk profile because of your answers to the risk questions, and it's globally diversified.
People could use your thing to just have a free risk profile tool.
Yeah. It's the price of transparency. People will steal your homework occasionally. But that's fine. That's what we're here for.
Yeah. I mean, you're sleeping just as well tonight if someone uses your Robo-Advice tool and doesn't pay you and doesn't even put their right email address in. Like, maybe you got them a pixel, but that's probably about it, right? Like, okay.
This is really solving for the question. I want to invest. I see you've got 4 portfolios. I want help picking which one of the 4 should I buy.
Okay, so you've recommended the Everest 90, as we mentioned before. So 90% growth, which is Australian shares, global real estate, global infrastructure, gold and cash.
Well, gold and cash is the defensive part.
Yes.
Yep.
Annual fees and costs. So the underlying ETF and fund fee.
Yep.
So that's just the investment.
So if you went and bought the same funds directly, that's what you'd pay.
Yeah.
You're not going to see it. It's just buried in the.
So they don't so someone invests in, what's your Australian A200 or VAS or something?
VAS.
Yeah. So you're not taking a clip on the VAS spread.
That would be illegal.
Yeah. So effectively, that's the underlying investment fee is 0.47.
So that's all those funds that go to make up that 90-10 add up on average to 0.47.
And is this screen here with the underlying fees and costs for Everest 90, just for the avoidance of doubt, this is based on my $20,000.
Yeah, so the $94 is 0.47% of $20,000.
Yeah.
You can do that in your head, I'm assuming.
The portfolio fee now.
So that's the extra cost of using this platform over going and buying it yourself.
Yes.
And what are you getting for that? You're getting the platform. You're getting all this anti-money laundering, know your client stuff. You're getting your tax reporting. You're getting your portfolio management. And you're getting your ongoing updates of the portfolio.
What would you say if, so the total cost. Well, actually, just on that, you can't really, like if someone is cost conscious, right, and they are looking at this and we're like, well, why would I spend in total 1.12% on Life Sherpa's platform where I can go and buy VDHG for 0.27?
Yep.
Well, the answer is you don't have to use Life Sherpa.
You go buy VDHG. This will outperform at lower volatility than VDHG has done over the last 20 years or 10 years. So I think the way you should look at that, Glen, is that the extra cost of using this is $130.
And that's what I want to get at. And that $130 isn't built into the unit price, and you'd claim that on your tax return.
Correct.
So it's a gross fee. And
the question is, well, if you make $50 an hour at work, how much work do you want to put into creating and managing a portfolio to save $130?
Yeah.
And how are you going to track the tax if you don't use the platform?
Yeah. So it's, again, people can do what they want, but there's a fee for a service. Now, another thing and we will keep going here.
And just to be transparent, which you'll see on the next pages, out of that 0.65, we get paid 0.4.
Right.
In fact, here it is.
Yeah. So what's OpenInvest?
So OpenInvest run the platform. So they're the responsible entity for
trustee, if you will.
Technically not a trustee. They're called a responsible entity,
right,
which combines much of the role of a trustee and a manager.
Yes.
So they're the thing that holds the license to run the platform.
Yes.
They get audited by ASIC. They run all of the technology. They do all of the trading, and we provide the intellectual property that says this portfolio. So of the 0.65, 0.25 is effectively paying for the platform, and 0.4 is paying for
your IP.
Our IP.
Yeah. Which you can steal your IP and use yourself, but can you rebalance it quarterly yourself?
Yep. And you also will find it hard to buy the managed funds. If you're investing $20,000, you couldn't invest in those managed funds because they have a minimum investment. You can invest in the ETFs.
Yeah.
Assuming you can get a marketable parcel. So if you're putting 20% in VAS and you're putting $20,000 in, what's 20%? That's $4,000. So yes, you could do that, but you couldn't buy the managed funds because the minimum investment is $20,000.
Interesting address there, Vince.
Radical transparency.
If you want to knock on that door after hours, knock yourself out. You might see someone in their underwear. Look, I think my biggest take for this is when we look at the Dunning-Kruger effect with investing, I'm a long way from the very start.
You're probably up at that peak where you know what you don't know.
Well, I've gone back down and back up, and what I might do is I'm going to just get that diagram up because it's going to make a good point.
Which diagram? The Dunning-Kruger diagram?
Yeah. Oh, I don't want all my personal stuff. Having a look here at the Dunning-Kruger effect diagram, with my investment, like if this is knowledge and time, I'm like at the end. And you find a lot of people who might just start investing and buy all my books and your books and really turn this up to 11. They're in the Facebook groups, they're on Reddit. They get to this point where it's almost ignorant. And those people who are at this peak here might be like, well, I'm not, because it goes back to, this is the weirdest thing. It goes back to a silly little fee discussion of 1 point whatever it is percent, where you probably, with respect, don't know enough to know the value of that, as opposed to rocking up and buying your VDHG or building your own portfolio.
Yep. And the distinction between a VDHG and this, well, VDHG is a 90-10 portfolio.
Yeah.
It's Aussie equities, global equities, bonds, and the global equities are part hedged. So there's 3 decisions you're making there. Maybe 4. I want a 90% portfolio. I want to put the 10 in Aussie bonds or global bonds. I want to be partially hedged for a currency perspective. All of those could be the right decision. And if you want currency hedging on your equities, this is not for you because we do not hedge equities, for global equities, because part of the point in investing overseas is to get currency diversification. You can construct an argument, which Vanguard do, that there are some benefits in hedging.
And
partially.
they've hung their hat on it, and that's fine.
And we've just looked at the evidence and we say, look, if you want to create a growth portfolio which delivers a return for volatility, so there's 2 dimensions to returns. There's the return itself and the volatility that goes along with that. And you want to make sure that you're getting you need to make one of 2 decisions. Do I maximize return for a given level of risk, or do I minimize risk for a given level of return? And you need to know which decision you're making.
Yeah. And with respect, when you're just getting started, you need to actually say out loud, I don't know what I'm doing.
Yep.
But that just takes time, and that's that Dunning-Kruger effect.
Yep.
And we've all been there. My first book, I share the story about the first and worst investment I ever made. Made all the mistakes. But we didn't have podcasts to listen to and, all the information now. So just back here on your website.
So this is what it's actually invested in.
So this is, exactly,
So it's worth having a look at. So large cap Australian shares, Vanguard Australian share funds, ASX 300, indexed, low cost. Then we allocate some of our Australian allocation to small companies. So these are companies that are generally outside the ASX 300, and they should be expected over time to give you a higher return than the big companies. Why? Because it's easier to double the size of a small company than it is to double the size of BHP, and they're notionally riskier, so you should get a higher return. We then look at global shares, and so we look at US and non-US shares. And the reason we do that is that if you just look at the global, if you look at an MSCI global index, the US is now 70% of it. So this is more of a fundamental allocation. So, well, the US is closer to 40% of global GDP, therefore we shouldn't be 70% invested in it. Then, of course, you've got the rest of the world. Then you move down to real estate, and that's core real estate. So no property development, no specialised property. This is
no internal debt.
No, this is
the underlying companies,
will, yeah.
But it's not an internally geared product with.
Yeah. So this is it's a ESG screened global core rental index. Then in infrastructure, this is a core infrastructure, which is roads, railways, power stations, utilities. And those 2 smooth out your returns without giving much return. And then we come to the defensive side. In the Everest, the defensive is gold, and this is physical gold, so the Global X Metal Securities ETF. There's an actual gold bar with your name on it in London, with a number on it that lines up with your investment. And so if you've got enough holdings in gold, you can go and get your gold. You can't do it if you own $500 of it, to be fair. And that's what gives an Australian investor a double whammy. So when you're investing overseas, when markets get tough, so global equities fall, Australian dollar falls because everyone runs to the US dollar, and gold is priced in US dollars, so it goes up and the demand for it goes up. So you get this double whammy. So if you live in Australia, Canada, or South Africa, you should have some gold in your portfolio. And I can't think of an Australian super fund that does. And then, of course, you got bonds, both Australian and global. And the global ones are hedged.
But I think this is just in terms of radical transparency, what more do you want? The reason I use it in, my self-managed super fund is because I'm Glen. I run a podcast talking about crap all day. I'm not a portfolio asset consultant. Like, I need to have an external vehicle that does the decision making for me, so I can focus on shoveling money into my portfolio, and then the platform in your portfolio every 3 months it likely rebalances.
Yep. And the other thing,
and that's the thing with the rebalancing discussion. And take this, insert portfolio in a box discussion here. Insert your model portfolio here. There are advantages to, I think, having the VDHG, DHHF, VDAL. If you're a casual observer and you just want to invest and get on with your life, there is really good advantages with this automatic rebalancing, because have you got the stomach, Vince, when there's a winner to sell down and put back into defensive?
That's the real challenge. And this is
have you got the stomach when it's Liberation Week and the shats hit the fan? Oh, I don't want to buy more. No, you have to remove yourself from the process.
So taking out the emotions from those decisions is critical to success. So VDHG, again, it's automatically rebalanced. You always get the same percentage of each of those funds. And that discipline for investing is critical. And that's the distinction between trading and investing. If you're a trader, you want to cut your losses and run your gains. If you're a long-term investor, you want to be trimming the risk back. So when equities run hard and the proportion of equities in your portfolio rises, you're now taking more risk. You should be taking some of that risk off the table. Over most timeframes, rebalancing does add value. Not over every time frame, but on balance, you could, by making sure that you retain your risk profile and the fact that you're buying low, selling high, does add value over time.
Yeah. So I think the main takeaway here is, technology has allowed this type of product. It's not a substitute for personal financial advice. It is a substitute for, I've got money to invest. I don't know how to invest it. I've told people check out the Life Sherpa website.
Yeah. So some of our members who say, look, I've got some spare cash. I might have inherited some money. I might have got some spare cash every month, got my home loan under control. And the question is, do I invest? Do I pay off my home loan, or do I put it in super? And if the answer is, do I invest, then this could very well be the answer for relatively small portfolios.
Is the platform fee, for want of a better word, 0.65 on all of the portfolios?
Yes.
Yeah. And then there'll
the only thing that varies between them is the underlying.
Yes, obviously.
Varies by a few basis points.
Yeah. So, look, we might leave it there. I don't know. I just think it's a cool thing. Vince is part of the furniture around here, and if you don't want, like, everything that we talk about here on the podcast, not every product service is for every person.
That's right.
So if you've been interested in having a look at this, and that's the weird thing, is like I feel like I have to disclose that I personally use this when I'm talking about it. Now, that could be seen as an endorsement. It's great. Like, I just know when people, like, I wouldn't talk about stuff that I do financially that much. It's really risky and speculative because it's not for everyone.
That's right.
Where on balance, if someone wanted to be a long-term investor, there is no harm here. I think that's what I'm
And,
saying.
all of our team at LifeSherpa invest in the same way, not necessarily in the same asset allocation or in the same vehicles. Clearly, my needs as a 62-year-old running a business is completely different to a 25-year-old first home buyer. But the same methodology and the same underlying funds apply, just in different proportions.
Yeah.
And all of our team invest the same way.
Yeah, and if you don't want to do this, you can steal Vince's homework and go, well,
Do it yourself.
yeah, they invest here in, let's have a look here. Oh, they invest in VAS, or they invest in, the OC microcap. I mean, you might not be able to go without 50, 20 grand if you went direct.
But it's interesting, like those two funds, the two small caps add about 0.6% a year to the overall return.
Yeah, right.
So that switch from 100% large cap Aussies. So if you compare this portfolio with 100% of the Australian allocation in VAS compared to splitting it out with the managed funds, they've got big fees, like they're 1% plus fees.
Yes.
But they add a net after fees 0.6% to the portfolio.
Yeah. So
why wouldn't you?
Exactly. Vince Scully from Life Sherpa, thanks for showing us your little Robo-Advice
Thank you, Glen.
document. And yeah, check it out. Let me know in the comments what you think. If you do use it, if you are a member, I'd love to continue the discussion in the comments.
Great.
Okay, bye.
Ciao, ciao.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.